So Kim, when we talked about having this conversation about trading psychology and technical analysis, you wanted to, you put forward a quote from the legendary trader Jesse Livermore. And I'm going to read it up here because I think it's such a great quote. I would love to do it in some sort of accent because I think it deserves it, but I don't think I'll try a 1920s accent. By the way, he was a legendary trader back as far back as the late 19th century and up till his, suicide in around 1940. But he says, this timeless quote is, quote, "Wall Street never changes. The pockets change, the suckers change, the stocks change, but Wall Street never changes because human nature never changes." And I think that's such a great sort of timeless quote. And it's actually probably from the actual book that was written about him, Edwin Lefebvre's Reminiscences of a Stock Operator. Yes. Probably the #1 recommended book at the top of every list for what books must the trader read. So what would you say to back up Jesse Livermore's famous quote there?
Yeah, I believe it's still true because what we have seen over the years and being in the market for decades, which I have and I believe you have,
is not too many decades.
No, not too many decades. We have seen that he was trading during the 1920s and was short during the 1929 crash. So, and that was a massive mother of all crashes, so to speak. And we have seen crashes ever since. We saw the .com crash. We also saw the subprime, and maybe also the next one. So it's the same behavior. It's the same, how can you say, pattern following every time.
But you're talking about crashes, but what precedes a crash, I guess that's the key point here.
That's the key point, yeah. The build-up. It's the build-up. It's the bubble where you can see almost everyone flocking into the market. And back then, there's the famous shoe polishers sitting outside of Wall Street giving out stock advice. And when I do my webinars and seminars and talk to clients about this, I always say, when your doctor or your taxi driver starts talking about investing in the market, it's time to get out. Because that's where they push the last, prices up to the peak where it really almost goes vertical.
It's an interesting thing to juxtapose here. So we have trader psychology, which we've mentioned a little bit here, and then technical analysis. So technical analysis sounds a little bit exact and dry and absolute in a way. Trading psychology sounds like something different. How do you connect the two?
Well, every time I'm being asked by all my friends and other people what I do when I do technical analysis, basically is I say it's psychology put on a chart. So the market reacts to all knowledge, all insiders, all rumors, everything. So everyone who is in the market or wants to be in the market or is leaving the market, it's their psychology. So it's mass psychology put into a graph, and that's the link. And the psychology behind it is the foundation of technical analysis, because in technical analysis we try to read the market reaction, because we say, well, as he said, human nature never changes, meaning that the same patterns, price patterns in the market, they repeat themselves. So that's what we try to then read these patterns, detect them, and say, okay, with the probability, what will happen next?
Okay, now technical analysis, it's quite technical. We've talked a little bit, it's about the application of these principles. There's an overlay of the psychology sort of appearing on the charts here. But why can't, if this stuff works, as somebody would say, the skeptics would say, why can't you just create a computer algorithm that applies it and you press go and it squirts out a good P&L day in and day out?
Well, it has been done, or at least been tried. We do have it on our platform, and a lot of IT experts or IT nerds that have tried to do that. Can we do it in an automatic way? Because the problem with us humans, I mean, I can only scan so many during the day, but a system can scan thousands in seconds on different markets and different time frames. So of course there's a lot of small IT nerds around that try to do it, and we have one on our platform, on our Saxo Trader platform, actually doing this. But The problem with it, they have to be very rigid. I mean, there has to be very set rules. If, the angle on the trend line should be this and that. Where with my knowledge, I can say, well, it's not really there yet, or it's not really a shoulder, head, shoulder, because there are also different opinions about what is a shoulder, head, shoulder, and where should it be, and the slope of a line in a triangle.
At what point is the neckline too sloped for it to be called a head and shoulder formation?
Exactly.
All these types of challenges.
And what is the trend preceding this? So it's like you can only do so much. And again, but it works, and we have seen it works. But again, there are also some, as I said, it has some shortcomings.
And I would say as well, to me, technical analysis, the most important application of it is in money management.
What I really try to get out there, say, technical analysis is not a way to get rich very quickly. It's a management tool. It's a risk management tool. It's how can I get into the market or out of the market? How can I get in with the least amount of risk? And that's how you try to find natural stops in the market and say, okay, I'm comfortable with this, and then I go in. You know your risk beforehand. You place your risk beforehand. You have decided it. So you take a lot of the psychology away, because you know beforehand, when you place the trade, you also decide your stop.
Right.
So risk-reward ratio is not interesting to me, because you can just say, okay, my reward is 10 times up, and then I have a beautiful risk-reward. But if your risk is still the same or even more, then you're still in danger of losing out, and you're in danger of being stopped out. So you have to find these natural stops in the market, and that's what you can use technical analysis for.
Yeah, and there's some behavioral analysis as well around this, and the reason to place stops beforehand is that you don't know what your future self is going to feel like during that drawdown. So it's better to place a stop when when your mind is cold rather than when you're in the heat of the moment. Now, we've talked a little bit about bubbles, and there have been so many episodes since we mentioned, of course, at the top of the conversation, the whole 1920s bubble. There have been subsequent bubbles. One of the most famous in terms of popular participation was the telecom and tech bubble, and that unwind sort of burned a generation of investors. And it feels like we've had another bubble here recently into the pandemic, and then the policy response to the pandemic and the enormous bubble in asset markets and specific sectors of the stock market. So it feels like we have a new generation here, also in cryptocurrency, et cetera. What does a new generation need to understand that's going on here, and what do they need to access to avoid the classic behaviors that Jesse Livermore talked about, the things that never change?
Well, the thing is, again, with human behavior, I mean, every time there's a new generation coming into market, and this time, and there was back in the 90s with the .com tech bubble, they don't believe it's a bubble. No, it's the future. That's the way it's going, and everyone. So what they should know is that it will happen to them too. Bubbles, they have the same characteristics. They have the same, waves up and down. Of course, it's very hard to predict when will it collapse and when will it peak out. We can only assume based on the indicators we have. So what should they learn? Well, it's about when they have seen the market going up like we have seen over the past few years, it's about keeping your stops close again. If it goes against you, get out, because suddenly you are 80% out of the money, which we saw back in after the 1990s and in 2000 and the zeros. And I believe there's still some out there holding Nokia stocks, which was really the big one back then, and they never recovered. When you're wrong, I mean, the first cut is the cheapest. And skillful, one of the most skillful traders, they have a lot of small losses, because if it goes against them, they're out. On to the next one. Don't worry about it. Take the loss, move on, find something else, or wait.
Along the line of being married to a position and hanging on to it for too long, there's a really classic picture of the legendary trader and investor Paul Tudor Jones, where he's sitting in his office with what at the time were very stylish 1980s glasses, but now look a bit funny. And he has on his wall a handwritten note says losers, average losers.
Correct.
Meaning doubling
Yeah.
down,
I
doubling
love that
down
one.
on a bad
Yes.
position
Yes.
is a terrible idea. So this whole hope side of things. What are some of the other big sort of emotions or attitudes or trading psychology, especially the novice investor, because the ones that have been around for a while, they've probably learned hopefully a little bit, but especially the novice investor needs to be aware of when they're getting involved with the financial markets.
Yeah, that's correct. Averaging your position is one of the worst thing you can do. It's a psychology thing, because if you look at your portfolio and see, oh, I am 20% out of the money. Okay, I double my position. Then it looks better. I'm only 10% out of money, but in real cash you're the same. So you're averaging, and that's adding to a losing position. It's the way to burn cash, and it's because you hope it will come back. Hope is one of the worst emotional thing you can have in the market, or when you're playing the market or trading the market. But you also have a lot of people. They have this where they fall in love with their investment, especially if they like the company. For example, Apple. They make great phones, so they also a good trade. Not necessarily, and just because you know the company or know their products doesn't mean you know how to trade it. And then you also have greed. We're all controlled by greed. We want to maximize our outcome, our profit, and that's why we are in the market. That's also why we want a pay raise. It's greed. It sounds bad, but it's not that bad. It's just you want to maximize your outcome and what effort you put into it. And then especially what we see here or have seen over the past few years with market going almost vertical up until around New Year, fear of missing out. And fear is not only when market goes against you, also missing out on a trade or missing out, oh, I could have been in there, I could have made money. So it's fear missing out.
Because after all, somebody had to buy that top price.
Someone has to buy it,
Yeah.
Someone has to buy it, and unfortunately, it's usually the retail investors doing it, because the smart money, the insiders, the fund managers, hedge funds, they start selling because they have seen this before, and they have skilled people with historic knowledge. They've been in the market for a long time, so they have a more analytic, clean approach to it.
Well, we have seen, though, something that's attacked that side of the industry and been quite a chaotic disruptor for some of these traders you mentioned, or investors really. You mentioned hedge funds, et cetera, and that is the rise of the meme stock.
Yes.
Where you have this crazy phenomenon of some sort of a clustering in social media around a certain idea or meme or single stock that's maybe not that large, knowing that there's some shorts out there holding a fairly large short position and then bidding up the stock to insane heights. GameStop was one of the classic ones. There have been others that you could mention. So this is, I would say that's almost a new thing. It almost is a totally new thing that we haven't seen. So even some things may never change, but some things do change occasionally, or they change at the margin and can have quite a big effect for single players in the market, for sure.
Yeah, but the psychology behind was the same. Suddenly a lot of people were afraid of missing out. Oh, it's going to 200, it's going to 300, going to 400. Oh, I should be in there. And then they buy it, 400, and then it goes against them. Suddenly they are 30% out of money, or maybe even 50. So now they have a hoping position, and then they add to it. They say, oh, but they say it's on Reddit, he knows something or whatever. Yeah. Everybody else made money. Why shouldn't I? And most of the people buying that stock, GameStop, they had no idea what they were doing in the first place. And suddenly they end up being, adding to the position. And then we're moving into another area where the more out of the money you are, the more risk you take. That's prospect theory. So you are willing to take more risk the more out of the money, or the bigger the loss you are running.
You start to have a lottery type of attitude
basically,
towards your position in the market.
Yes, you are totally caught up in this psychology world without knowing it. I mean, you are controlled by your emotions and your fear.
When you're looking at trading and you're finding a broker or an online or investment bank to trade with, you have an outfit like Saxo, which has the sort of complete suite of technical analysis, all manner of educational videos, things that can really help you climb the ladder towards finding your own success. But there's only so much work the platform itself can do. There is a lot of psychology that the individual trader and investor needs to work on. So what are a couple things you would look at to help them not only use what tools are already available there, but to work on themselves?
Well, first of all, I would say to new traders and new investors, write down when you're investing. Keep a trading journal. Write down, I bought this because of this and this is my stop, and I keep to it. And you can use technical analysis or the charts to time your entry into the market. So you have to try to minimize the psychology at least a little bit. And then you will learn from your mistakes. If you write down why you do this, it makes you think slow and maybe think about it again. And then you can always look back and say, okay, why did I invest in this and that? And why did I take my profit or loss here? So you are disciplined.
You're interacting with your own history in a way.
Exactly.
To try to learn from yourself.
Exactly. And then you can adjust on the way. Say, okay, that didn't work. Maybe I should adjust a little bit here. What did work? And then you can learn from yourself on the way. It makes you think slow again. It's really, really important instead of just start, oh, I should be in, fear missing out, buy, sell.
Or in a strong reaction to a data. In the case of foreign exchange, the classic thing is a data release that inspires a large move in the markets. I'm familiar with this. You're really tempted sometimes to jump on board the move because it was a surprise data point, but going into that data point, what is the market focusing on? What is the narrative? Is this really that big a surprise relative to what people were expecting? There's a big central bank meeting tomorrow. Maybe that's more important than this single data release. All these kinds of things are so important to learn from the environment, and that the environment itself is changing, the narrative's changing, but one of the things you can do to control yourself is to stick to a plan.
Stick to it, and even if you see maybe a market spiking up or collapsing briefly, often we see that with numbers coming out, and then market suddenly comes back to where it was. It was just a short reaction. If you still have your strategy, stick to it, and then you can reassess it afterwards. Or
alternatively, going into the number, maybe a really bad number is really going to shock the market narrative here. So I need to jump on board. So it can be very different, the type of behavior, but then it's all about journaling the plan and having the plan before, so that it's not the heat of the moment that determines your reaction, but it was the plan.
Yeah, it was the plan. It wasn't panic moment. It wasn't heat of the moment, or oops, now it goes against me. What will happen? Oh, sell or buy or what? Yeah, correct.